In today's video, we're going to talk about how sharks know whether a company is worth investing into and whether the valuation that person is asking for is fair. Welcome back to the channel. If you're new here, please consider subscribing. We talk all things personal finance, but we also talk a little bit of business finance, and today we're going to go into everyone's favorite show, Shark Tank. So again, just jumping right in, how do sharks understand if a valuation is fair? So it all starts out the same way. Hello sharks, today we would like $100,000 for a 10% equity exchange in our company, and that equals $1 million valuation. So the sharks immediately are thinking, okay, is this company worth investing into? One, and two, is $1 million a fair ask? If you're having a hard time calculating the valuation, how you get the math behind the $1 million, please feel free to click the link in our description. That is our most popular video on YouTube, so if you want to watch that beforehand, please feel free. But we're going to keep moving, just assuming you understand the valuation portion. So now, if we're trying to decide if that's a fair ask or not, there's a few things that we need to look through. Well, the first is, putting it another way, if the sharks were going to buy the entire company, would the price be $1 million? That's the same thing as $100,000 at 10%. And some of those major factors, I'm sure you've heard on the show, these are the main questions that they ask, right? What are your sales? Show me the dollars, as Kevin O'Leary would say. Number two, what does it cost for people to buy, and what does it cost you to make it? Those questions help them understand the profit and the margins that they're making. Three is cash flow. How much cash have they had to invest into the business? How much are their expenses on a monthly basis? The next one is competition. Are there a lot of other products out there that are similar to this one? That's going to hurt the valuation. Then the last one is, do they like the entrepreneur? Sometimes you hear them give offers just because they like the person pitching. They're investing in them, you've heard them say before. Then other times they just don't like the founder, which could hurt the valuations. So we'll talk about those more in depth, but those are kind of the major decision points. So the next one, let's use an example because I think that's the easiest way to understand how these valuations work. Let's talk about Ring. Ring actually did go on Shark Tank and got rejected. So Ring Doorbell went on and they asked the sharks for $700,000 in exchange for 10% in the company. So they wanted a $7 million valuation. Now at the time on Shark Tank, that was an extremely high number. If y'all remember back to the beginning of the show, a lot of people came on asking for, $100,000 for 50% in the company, or like a $200,000 valuation, things that were very small. And then as Shark Tank grew, the size of these companies, coming and asking for money was insane. So $7 million valuation was very high at this time in the show. So unfortunately, all sharks but Kevin declined to give an offer for multiple reasons. But mainly things we talked about. They were concerned about the number of competitors like, ADT, big security companies, and the cost per unit. Ring said that their price was $200. Now, hindsight 2020, we know a bunch of people bought at $200, but this is what the sharks were faced at the time. And so for them, they did not think that $700,000 at 10% or a $7 million valuation of Ring was a good deal. Kevin did offer, but his offer with a royalty was rejected. So now let's fast forward. How do the valuations play out? Well, what happens with these companies is there's two paths they can go down most of the time, right? They can either decide to go public or IPO. They would get traded on the stock market, and they get a final valuation that way, or they get acquired by bigger companies. In Ring's case, they got bought out by Amazon. In 2018, Amazon then bought them or valued their company at, it's all the same thing here, for $1 billion. Crazy amount of money. That means if the sharks would have made a deal at a 10% stake in the company, that was worth $100 million when they sold. And all for a $700,000 investment. So hopefully that makes sense, because that's very important, I think, to understand the end game first. Is when these companies get bought out, that's where the money is really made in these valuations. So because it was sold for $1 billion, the 10% stake, 10% of $1 billion is how you get that $100 million worth. And at the time, they could have gotten 10% in the company early on for 700,000. Would have been quite the return. Unfortunately, though, the sharks did pass. So let's say they come in and they ask, let's talk about profit first. Let's say they come in and they ask for $1 million valuation and they're making $100,000 in profit. We like in finance to talk, in multipliers or percentages a lot of the time. So essentially what this is they're asking for a valuation of 10 times profit, $1 million valuation with the 100K. So how does that 10x compare? Well, the hard part with Shark Tank is a lot of these companies are very young, right? They don't have the track record to be able to say they may have only been in business for, a year or two, or even less than that sometimes. So it's hard to do a multiplier of profit because sometimes these companies are even still losing money. So in general terms, like I put this down on here just for reference, Apple's valuation to profit ratio is 22 times. But obviously Apple is a very stable, number one company on the planet. So you can't really always use those kind of multipliers when you're applying them to very new companies. And so again on here, what if the company is still losing money? Well, you can't use a profit multiplier because they have no profit. And so then that's when the sharks would have to go to, okay, well, let's compare to their sales. So if they come in and they have $1 million valuation with 100K in sales, now they're asking for a 10x of sales instead of a 10x of profit. Well, you could always have this problem. Now, this is more rare on Shark Tank, but what if the company is pre-revenue? So if they're not making any sales yet, again, you have the same issue. So they'd have to start valuing something else, which we'll talk about in the next section. But if they do have sales, what is that multiplier they're asking for? Ring sales at the time, so back to our example, was $1 million or a 7x ratio. And the sharks still didn't invest at 7 times Ring sales. And then I would say the average Shark Tank ask is anywhere from 3 to 7x sales. It varies greatly. I tried to go back and watch some of the pitches and just write down the math for all of those ratios. Some people come in with a crazy high valuation, and that's when they get laughed at by, the sharks. But I would say the average, and especially the completed deals, is anywhere from 3 to 7x sales is where these companies are landing. Okay, so the last one then, so if they can't value the company off profit, if they can't value the company off sales, well, and even still if they can, a very defining question is, well, what is the future growth potential? Can this business be a $1 billion company? So even if they're not making a profit now, right? If they're losing money, but their sales projections are incredible, or the sharks believe that this company can grow into something much larger, then they may be more willing to attach a higher valuation because they're adding in future sales growth. The product incredible, or is there a huge desire for this in the market? So there's a lot of those things where, it's a gray area. It's a decision-making process for them that says, okay, well, if it's not, worth this today, can it be worth that in 5 years? They try to take that long-term view in valuing these companies. So hopefully that was helpful. That's all we had. Again, I love Shark Tank. It's brought such a new exposure to new companies and how to value companies and how this process works with startups. So hopefully understanding, the valuation math itself, if you want to watch that video again in the description, and then how they understand if that was fair will help you. So again, if you could smash that like button and subscribe to the channel, we greatly appreciate it. Thanks again for watching, and remember, finance is fun. See ya.